All right, let's dive right into this explainer, breaking down the upcoming American market debut of memory giant SK Hynix. We're basing today's deep dive entirely on some truly fascinating financial analysis from Wiz-Works. The memory chip market has been on an absolute tear lately, and SK Hynix's arrival in the US market is drawing massive attention from the financial world. But we've got to ask, how much of the current hype is built on unshakable fundamentals, and how much is just fragile math on paper? All right, let's dive right into this step-by-step analysis. We've got 5 main areas to cover today. First, the memory market landscape. Next, sizing up the addressable market. Then we'll look at the super cycle valuation model, followed by the historical valuation model. And finally, we'll wrap up with disruptors and market risks.
So starting off with Section 1, the memory market landscape and how we price producers.
To really understand SK Hynix, you've got to look at the current environment, which is seeing some pretty wild fluctuations in valuation multiples. Comparing them to a massive peer like Micron gives us a really good baseline perspective. Just over the past year, Micron's share price literally multiplied nearly tenfold, with their EV to EBITDA multiples shifting from around 6 all the way up to 30, before recently contracting down to 16. Now, SK Hynix enters the picture offering a massive 58% share of the high bandwidth memory market, along with better margins across both DRAM and NAND. Currently, they're sitting at an 18 times multiple, so the market is pricing SK Hynix just a bit higher than Micron right now, but the broader question remains, how stable actually are these multiples for memory producers?
Well, this quote from the source material hits the nail on the head. It says, the same moat NVIDIA has made out of CUDA cannot be made out of HBM, as memory behaves more as a commodity. This is an absolutely crucial point to keep in mind. You see, memory chips just aren't GPUs. GPUs have these unique parallelization pipelines and deeply integrated software ecosystems like NVIDIA's CUDA that literally lock customers in. HBM, despite being incredibly advanced and highly sought after for AI applications, is ultimately still memory, and memory fundamentally trades as a commodity. For an investor, understanding this distinction between an ecosystem moat and a commodity product is really the cornerstone of assessing risk here.
Moving on to Section 2, sizing the addressable market. Keeping that commodity aspect in mind, you might be wondering, how did these elevated multiples mathematically make sense? We have to run the numbers on the total addressable market, or TAM. If we follow the if-then logic of the bull case, if this bullish TAM is fully realized, SK Hynix's revenue projects to hit anywhere between $175 billion and $200 billion. If you apply their current margins to that, it converts into roughly $125 billion to $144 billion in EBITDA. It is a massive projection, and it forms the absolute foundation of the current market optimism we're seeing.
To put that into perspective, the scale of that growth is staggering. That projected $125 billion in EBITDA, that's a 5x multiplier over their estimated 2024 EBITDA, which sits at around $25 billion. Basically, the market is pricing in an environment where earnings literally multiply by 5. All right, that brings us to Section 3, the super cycle valuation model. So to justify paying for all that future growth right now today, analysts lean heavily on what they call a supercycle theory. Let's just walk through the math step by step. Step 1. We assume a supercycle playing out over a 20-year period, which, let's be honest, is a pretty bold time frame when you're dealing with the tech sector. Step 2. Over those 2 decades, that generates about $2.5 trillion in total EBITDA. Step 3. If we discount that at about 5% per year, the present value comes down to $1.4 trillion. Finally, Step 4. You subtract the $280 billion in discounted earnings you'd expect in just a normal baseline cycle. What you're left with is roughly $1.1 trillion of value added. If you divide that by total shares, it yields a valuation that is incredibly close to the current share price at that 18 times multiple. So what this data tells us is that if we are currently sitting at the peak of a 20-year supercycle, a huge chunk of that upside is already priced in.
Which brings us to a really critical pivot point in this explainer. What if it's not a supercycle? What if we're just looking at a standard, albeit dramatic, market cycle?
Let's explore that in Section 4, the historical valuation model, looking at a 5-year reversion. Let's actually model what happens if demand just goes back to historical norms in a much shorter time frame. Scenario A was our 20-year supercycle, bringing in $2.5 trillion in undiscounted EBITDA. But Scenario B assumes that in just 5 years, memory demand goes right back to historical levels. If we take an optimistic peak of $170 billion in EBITDA and apply it to a 5-year reversion, it generates about $850 billion undiscounted.
When you discount that down and subtract those baseline normal cycle earnings, the valuation perfectly matches the historical 7x multiple this industry is totally used to. This contrast is pretty eye-opening. It shows us that the market is currently pricing in many years of sustained future profits, not just a quick burst.
And that leads us to our final part, Section 5, Disruptors and Market Risks. Because look, no mathematical model exists in a vacuum, right? We have to look at the variables that could totally alter these forecasts. The source data points out a huge structural dependency here. These massive total addressable market forecasts rely heavily on getting a higher price per byte, not just selling more volume. Sure, actual byte volume is increasing by a solid 15 to 20% year over year, but the actual value assigned to those bytes, that is modeled to jump anywhere from 70 to 300%. And historically speaking, when you're operating in an industry throwing off 60 to 75% margins, that acts like a magnet for intense competition.
And that competition matters a ton when you look at SK Hynix's revenue split. High bandwidth memory, or HBM, gets all the flashy headlines and drives the whole AI narrative. But actually, 90% of SK Hynix's revenues still come from standard, everyday commodity DRAM and NAND.
Because of that revenue reality, competitors like CXMT become highly relevant. Currently the fourth largest DRAM producer globally, CXMT is part of a massive domestic memory build-out in China, aimed at reducing their reliance on global prices. And get this, Apple is reportedly even looking for approval to use their chips. The huge takeaway here is that a disruptor like CXMT doesn't even need to match SK Hynix's cutting-edge HBM capabilities. To completely upend these financial models, they just need to flood the broader commodity DRAM and NAND market with cheaper supply. A producer selling at a 50% discount would absolutely be enough to alter those massive TAM forecasts.
So we're going to leave you with this defining question. Will the total addressable market hold strong at upwards of $350 billion, or will new supply just flood the commodity market? The math shows us that if this 20-year supercycle narrative stays perfectly intact, SK Hynix's ADR could potentially see $250 to $300. But if there's any break in that narrative, like a sudden flood of commodity supply or a compression of these high multiples, well, that upside could recalibrate pretty fast. It really is a delicate balance of pricing in the future of memory against the historical realities of past cycles. Thanks so much for joining me for this explainer, and we'll catch you next time.